are on the line with Nic Chahine. He is a Marketfy Maven, an options expert. He joins us every Tuesday to discuss this week's options outlook. You should check out his product on Marketfy, Create Income with Options Spread. Nic, you have given us words of caution here for the last few weeks. Is it time to stop being so cautious and get in here and buy this market?
No, sir. My message
No,
has not
sir.
changed. I'm not forecasting further downside, but I have to make room for it. And you have said in the last 5 minutes that the weeklies are hard to game. The weeklies are in the current weeklies, and the next week. Give yourself time.
Yeah.
Playing the weeklies out in time is just fine. It's not the nature of the weeklies themselves, but if you try to game them into the end hours, this is when it gets pretty tricky on the long and on the short side too. So stay long as far as your thesis is concerned if you have one, because price action right now has nothing to do with the fundamentals. We're just going on headlines and sentiment, and one drives the other. Combine the two, it's a complete mess. So really the people that invest with fundamentals are kind of like stuck. They're hostage. And so until those two, until we resolve a couple of the possible shoes that are looking to fall over our heads, we can't go in and say, I'm convinced that Apple's a good buy here. So who cares if Apple is a good buy here if the markets are going to fall on a Glencore headline, for example? So you have to make room for it. And that's what I've been saying. Here are the ranges, but I can't trust them in the short term because of these looming headlines. So who cares if I'm right 100% on the ranges? If they decide to sell, they're going to sell. So you have to make room for it. You mentioned, for example, Veritex. Let's see, Valiant. I'm sorry, not Veritex.
Yeah,
Valiant.
Valiant,
How it fell hard, but as hard as it fell, if you believe it, it's still higher than the start of the year. So can't it fall further? Of course it can. Just expand the chart to 2 years and you'll see, whoa, there's plenty of room to fall.
Expand the chart to like 7 years. Go back to the financial crisis. This was $7. $166 6 years later. It's had a hell of a run still.
But it's more relevant to stay within the price ranges of the last couple of years to see perspective, a little better perspective. Because if you see that candle and you go, whoa, that's a washout candle, I'm going to buy. Or it's not going to fall any further, I'm not going to protect it. I'm not going to book my profits. There are still people with a lot of profits just from 10 months ago. So they can still decide to get out. I'm saying that even though I'm not calling for lower prices, I have to make room for it. So if I was in Valiant and I still had profits, I'd book them just for that. Or I'd buy some puts. Or I'd sell some calls against my assets. So I do stuff. And this is where people that don't use the options market, it's perfect time to get into the options market the right way. Go take some classes, read some books, do some research. There are plenty of ways where you can shore up your portfolio without spending a ton of money and reducing your exposure.
Nic, let's ask you, and I just want to know if you're doing anything on Priceline here, because this has had some tremendous volatility the last 2 days as well. Friday high after Yellen comments, almost $1,300, got up to $1,298. Yesterday's low, $1,192, so quietly lost $106 in 2 trading sessions there. I know you're a big fan of writing, credit put spreads or credit call spreads, depending on your view on this stock. Are you doing a little bit of that here right now, or are you hands off just because there's so much volatility in it?
Well, you know what? I was looking at it. I almost shorted it a few days ago, but I didn't. I drew a few lines on it yesterday, and I'm looking for the 11s. Where are we now? 11.99.
Yeah.
So I was looking to see the next few candles if they're going to breach an ascending trend line that would put it somewhere around the $10 lower from here. If it breaches that, it could wish down to 1100, which would be a decent place to go long, assuming that the market's stabilized. Remember that this one moved $100 a day. It has moved $100 a day with no problem because of A, the price of it, and B, it's a momentum stock. The good thing about it is that it has good fundamentals. But the one thing that's fundamentally bad about it is the Europe deal with the VW. Believe it or not, it will impact Eurozone spending, because if it's true that 1 in 6 jobs in Germany is touched by the auto, remember what the debacle in California. Southern California is like 25% of the jobs depended on the home, mortgage, building, whatever, housing, and it impacted spending in that area. So if that's true for Germany, you know that the fundamentals there for the whole Eurozone are going to be a little challenged if, VW's story is not just VW, and VW itself is the largest company on the planet, auto manufacturer, and they're going to take a tremendous hit to the bottom line. So it's just going to trickle down and out. So I'm cautious with that. So I'm not rushing into anything in Priceline. There's always a trade in Priceline, so I'm not rushing into it. But yes, you can start sniping some credit put spreads. But you guys said something. I'm going to go do leaps. I think it was you, Joel.
Yeah. Yep.
That's the easiest way to trade Priceline. Okay, leaps.
Going out long ways.
Way out. And when premiums are elevated so much because of the VIX being high, then that's perfect time to do leaps on it, because when things go back to normal, the premiums deflate and you can book the profit by buying the risk back if you want.
Nick, can you set the listeners up here just with a hypothetical example of what you're talking about on Priceline? Like what price would you be looking at if you were doing, the leaps, and would you be looking at a credit put spread? Is that how you'd be approaching it? Maybe looking at like the 1150 or the 1100?
If I were, no,
way you go farther out. You go way farther out.
I'm way out. Credit put spread in Priceline at 1100, you can get there in a day and a half.
What strike do you look at? Like how far do you put the money?
I'll give you an example. If you go to December on Priceline, let me. I got to expand my picture here. 12 strikes on my screen is not enough, and I'll change the price here. You'd be surprised what people pay as far as premiums in Priceline. I'll give you a ridiculous example here if we can get to it pretty quickly. Okay, the 945 put pays $7 in November.
This November.
This November, the 945 put pays $7. So
that thing
that's the kind of nervousness that's built into the markets. So if you want to sell a strangle at 945 and at 1500, you can book probably $1.50. I mean, sorry, $7, and it's probably $7 up there too.
$15.
So it's the premiums are high. And if for example, 965, 970 probably pays, 70 cents, something like that. And that's on a risk of $5. The yield is huge. You think, okay, you're risking $5, but I'm getting paid the yield on money at risk, 70 cents on $4.30 worth of risk. Where can you get that kind of yield at this safe of a distance? Nothing is 100% safe, but it's a lot safer than buying it here.
But you would never leave yourself open-ended either, correct? For that like fat tail or black swan event, because that could get you. No. You always cover yourself, right, and buy like a lower put just to have yourself hedged off.
I do a spread. So if I were to trade it, I would much prefer. I never recommend selling naked puts. The only way you would sell naked puts is if you're willing to own the stock at that price. Then it's a perfect thing to do. If you say, oh my gosh, I'd love to buy Apple at 85, well then sell a put at 85. So if Apple indeed gets to 85, then you're in at 85 and less because you collected the premium for that. And if you're really bullish at 85 and you don't mind owning it at 85, but you don't want to risk your money on Apple right now because you don't want to go down from 112 to 105 on a technical note. So you can sell a put at 85, collect some money. With that money, you buy some calls and you're long Apple for free. And if Apple falls to 85, hey, you're long Apple like you wanted at a much lower price. These are just hypothetical.
And if it just meanders, you take in the premium. You can take in the premium to go out and purchase, do the same strategy again, or actually purchase the stock. Well, just going to Apple here, I mean, the show's not complete until we talk about it. Holding up really well here. $3 off the high in the move here. I mean, I'm telling you, this 116 level, I don't know if you've taken a look at Apple lately. 116.89 has been the flash, what do we call it? about this? Flash FCRH, flash crash rebound high, 1689. You've taken 5 other shots to get there actually on Friday. You hit 1669. Just all kinds of crazy support here at the 112 level here. Is it enough support for you here to take a shot? Maybe a little move back up to this 116 and a half, 117 area. Or is it too market dependent?
Well, I first of all, you call it crazy support. I call it a must-hold level. If you call it that way, then you wouldn't be so exuberant about buying it. First of all, fundamentally, it's the best company on the planet. And as far as the markets, they have a lid on them. Now yesterday, something happened that hasn't happened in a long time. There was clear selling the rip. Any bounce is being sold. Yesterday it was 100% clear. The bounces are being sold. And there was 100% fear yesterday. I haven't seen fear even during the flash crash, because the day after the flash crash, what rebounded? The Momos. All the momentum stocks, money piled into Netflix, Priceline, GoPros, I can't remember the names, but a lot of momentum stocks were green, green, green. Yesterday, what got pummeled? The momentum stocks. And the healthcare, which is biotech, which is on a huge rip. I've been warning for months that the biggest risk on the markets, especially the NASDAQ, are the box that is healthcare. It's as big as Apple, and Apple at least has fundamental. And that, not that they don't have fundamentals as a collective, the healthcare biotech, but they have too many new profits. And those are easy, weak hands, push, sell, book. That's why I'm saying, even though they fell in their quote in whatever, correction territory, it doesn't matter. Just like the Chinese markets, they went up so high that even falling 20, 30% leaves another huge chunk down that it's still profits, recent profits. So yes, Apple is the grown-up in the room, and it's holding up real well, and the markets owe it a lot. Otherwise, we would have tumbled. But these are must-hold levels, and that's how I'm approaching everything. Must-hold levels. Again, I'm not calling for it, but it's too easy to break that level and come down to 105. And if you do come down to 105, technically 90 is not that far. It's not a perfect head and shoulder. I'm not a technician, especially that you had a breach with that flash crash, poke, breaks the neckline and everything. But technically the price action is head and shoulder-ish. And if this level falls, 105, 106 is in range, and that level must hold, because then you can whoosh down. I'm not calling for it. I'm long Apple credit put spreads out in time, so I don't want that to happen, but it is possible.
Everything's a possibility. What's the must-hold level in Alibaba?
Oh, my God. Alibaba, you remember every time I came on here, I said it's a slammed-on company, buy, unless they're lying. Well, turns out
they were lying.
They were lying, or at least there's a good chance of them being lying, so I haven't looked at it or traded it. And I have nothing to shoot for. That's a low, right? That's an all-time low. So what am I buying? I don't know. I have no visibility to it as far as no reference points. So I just ignore it completely. Technically speaking, if I look at the open interest, and let me see if I updated it. I did update it. It can't break 60. Too far from 60 this week. It should stay at 60. So it's kind of a
magnet.
Well, it's not a magnet. It's a resistive magnet, so it won't be much support. There's tiny support somewhere around 58, but I don't think they're going to run with it. But if there's a headline, then headlines always supersede the open interest data. But the natural price progression this week should be limited at 60.
One more here, Nick, for you. One that we ask about every Tuesday with you is GoPro there, because you've had some great calls on this one in the past. GPRO continues to drift lower here. Made actually the lowest point since its IPO day, breaching 30 for the first time since the IPO day. Is bouncing here a little bit this morning. We got Stern AG initiating it with a buy, so it is trading up about 50 cents here. But what are your thoughts on GoPro?
Well, it was a little disappointing yesterday because the last two candles prior were showing a breakout from like a falling wedge of sorts that would have given it quite a run. But just like Baba I need a reference point, and I did not pull the open interest on it. Maybe we can quickly take a peek at it, but I would only play it on the long side if I want to with a debit call spread, cheap money, nothing serious. So fundamentally, I have no reason to chase it. Technically, I have no clear picture of it. But if markets bounce, it should bounce. If markets fall, it should fall. So if I'm hopeful for GoPro, first of all, if I own it, I've got to guard against more downside because I don't know why it wouldn't fall if markets fall. But if I want to go long it, I would not give it a lot of money. I would just use small money with a debit call spread, which where you would be bullish, you would buy a call, and to reduce your entry cost, you would sell a call higher. And if markets go through both these legs, you profit the difference between the costs. So the maximum loss is the cost you pay up front. Maximum gain is the difference of that cost between that and the spread width. So that's the only way I would play it because I really don't have much information other than that.
One more tough one for you here is something we've been talking about on the show for a while. Walmart. Nice dividend here. This has been coming in here. I mean, you're looking at the monthlies here. Yeah. Any words of advice on? You're laughing, Nick, because we're asking you about Priceline and Walmart. Nick, you cover everything.
Yeah, no, Walmart. I did post a picture of Walmart not too long ago. Unfortunately, not good. I said Walmart's management needs a smack on the head because they've let their stores go down the hill. Walmart, when it was founded, it was on brilliant merchandising.
Hey,
Yeah.
Nick, I'm sorry. We got you cut off. Just final thoughts on Walmart.
Okay, no, Walmart, I think management lost its ways, and I can't trust it on the long side. Technically speaking, when they broke 70, I pointed out that 60, 61 would be the target, and it almost got there a few days ago, and it looks like it's headed down there. I won't chase it until it gets there, if it gets there. If it doesn't, then I'll miss a few bucks on the upside rather than jump in too soon. Management really needs to get back on track for that one to fundamentally be attractive to anybody because they sell stuff just because they're cheap, and that's it. It used to be because they're cheap, and it was somewhat of a decent shopping area. Right now, the stores are poorly staffed, poorly displayed, and not a good, pleasant experience for anybody to shop there.
Nic Chahine, a Marketfy Maven, options expert. He comes on every Tuesday at 8:35 to discuss this week's options outlook. Marketfy Maven, if you like what you're hearing from Nick during our interviews, check out his product, Create Income with Option Spread.